In this video, we will cover some additional ratios that start on page 90 in your textbook. Let's assume we're given total revenue that would be the same as total sales of $120,000. Net farm income, that would be the amount after you subtract expenses, is $80,000. Average equity, that's the average amount of capital that you have invested in the company during the year, $200,000. Average assets, that's the average value during the year of all your assets, $300,000. Let's say that on loans you've paid interest expense of $12,000. And you also have opportunity cost on labor of $15,000. Opportunity cost of management, $9,000. What is opportunity cost? Well, it's derived from the recognition that when resources such as labor are used on one project, opportunities to use these resources are sacrificed elsewhere. You can't use them to make money on another project, even if that one may make more money. For example, you may have given up a full-time job in order to go back to school. Going back to school means that your opportunity cost was that full-time job or the salary that you received from that full-time job. Let's assume that you would take out for your family living expenses $25,000, and also taking out of salaries is income tax, state and federal income tax, and Social Security tax at $5,000. And the opportunity cost of capital, where you might be able to make money elsewhere or invest it elsewhere, is 8%. So let's start with page 90. Rate of return on assets. That's going to be the return to assets divided by your average assets times 100. You first of all have to calculate the return to assets. So I've already done some of the work for us. We want to add the numbers that are given, the net farm income, plus the interest expense, and we want to subtract out the opportunity cost of labor and the opportunity cost of management. Again, those numbers were all given up above. So when I total this, I get return on assets of $68,000. So therefore, I will take that $68,000 divided by average assets, which are given up here of $300,000, and to get it as a percentage, I will multiply it times 100. So I will take 68,000 divided by 300,000 times 100. So 22.67% return. So that means for every dollar I've invested in assets, I'm getting about 22 cents back as income. Next, on page 92, the rate of return on equity. I first of all need to calculate my return on equity. Again, given is a net farm income of $80,000. I subtract out the opportunity cost for labor and the opportunity cost for management. When I do my calculations, I come up with return to equity of $56,000. I will then take that $56,000, divide it by my average equity, which is given up above at $200,000. And again, to get it as a percentage, I will take it times 100. That would be 28%. So every dollar I've invested, put into capital in this company, I'm getting back 28 cents in return. The next one we're going to look at is on page 93, operating profit margin ratio. I first of all need to add net farm income plus interest expense and take out the opportunity cost of labor and the opportunity cost of management. When I do my calculation, I come up with operating profit of $68,000. I will take that $68,000 divided by total revenue, which is given up here at $120,000, and then multiply it by 100. I get 56.67%. Okay, next I will calculate change in equity. This formula is on page 95 in your book. You want to take the net farm income, which once again is given at $80,000, You want to subtract out the amount that's taken out for family living expenses, which is given at $25,000. And you want to subtract out any payments that you've paid for income tax and Social Security tax, which is given at $5,000. Okay, so 80,000 minus 25,000 minus 5,000 gives us $50,000. And we'll go ahead and format that with a dollar sign. Next, we'll take a look at calculating the return to labor and management, and finally, the return to management. So we first of all need to get what's known as the adjusted net farm income. That will be the net farm income plus the interest expense. Those were given as 80,000 and 12,000. When I add those together, we get 92,000. Next, I need to calculate the opportunity cost of capital. That will take your average assets, which are given at the very beginning as 300,000, and taking it times the cost of capital, which was given at 8%. That would be $24,000. Next, I will get my return to labor and management, and I will do that by taking the adjusted net farm income of $92,000 and subtracting the opportunity cost of capital that I calculated earlier of $24,000. That gives me $68,000. So to get the return on management, I'll start with what I just calculated, the return on labor and management, which is the $68,000. I will subtract out the opportunity cost of labor, which was given to me in the beginning at $15,000. When I calculate the two together, my return on management is $53,000.